What's up everyone? Today we're going to be breaking down everything you need to know about day trading. So even if you know literally nothing about trading at all, I'm going to be discussing the most important trading concepts so that by the time that you finish this guide, you will have comprehensive knowledge on how to move forward with your day trading career. We will cover all of the important topics, so make sure that you set aside some time in order to absorb this important day trading lesson. If you want to freshen up on a specific topic, check the description below to see a breakdown of all of the chapters inside of this guide. With that being said, let's jump into the lessons. Okay, so first let's break down what day trading actually is. When you're buying and selling a stock, you do so with the goal of eventually turning a profit. There's investing, which is long-term buying and selling. And then there's day trading where you're buying and selling within the same day. So the objective is obviously to make money, but you're using a strategy or system in order to know when and where to buy and sell specific stocks and have a statistical edge over the market so that you can do so and generate income day after day. So let's break it down to the super basics and explain what stocks are and how you can buy and sell them to make money. Stocks are basically a piece of ownership in a publicly traded company, so that when you own shares, you basically own a small piece of that company. So if a company performs well, those shares will increase in price and the value of what you hold increases in price as well, and that in turn increases your wealth. So let's say, for example, you are looking at the stock XYZ and it's worth $10 per share, and let's say you buy 100 shares of that company, so you invested $1,000 into it. And let's say the company does really well revenue-wise, has good news, it strikes a contract or whatever the catalyst may be, and the share price appreciates to $15 per share. If you decide to sell your 100 shares to a market participant, you would get back $1,500, netting a $500 overall profit on your trade. Now, obviously, this can work against you as well. For example, if that same company dropped terrible news like bad earnings outlooks, had some sort of investigation launched into the company, or filed for toxic dilution, the share price could drop to $5 per share, and now your $1,000 is worth $500 only. So this process of buying stocks with the idea of buying low and selling high is commonly referred to as going long or longing a stock. And there's also an opposing type of trading called going short or short selling, where you're essentially looking to sell high and buy low. This means that you can make money when you bet against stocks and their share price goes down. The way this works is essentially by borrowing shares from your broker, selling them at a high price, and then waiting for the price to fall and buying it back at a lower price, then returning those shares to the broker. Your profit is the net difference. So, for example, if you choose to short 100 shares of XYZ at $15, if the price drops to $10, you would buy those shares back, also known as covering, and make $5 per share on that trade and profit $500. Now, this doesn't include fees associated with shorting like the cost to locate shares and other commissions, but that's how the overall idea works. Now real quick, it's important to understand what can happen if you are wrong on a short selling trade. Because when going long, the most you can lose is your initial investment, right? For example, if you invest $1,000 at $10 per share, the most you'll lose is $1,000 if it drops all the way down to zero. This is flipped around for short selling though. If you short 100 shares at $10, technically it could go to $20, which means if you wanted to close a position, you'd have to buy 100 shares at 20, which would cost you $2,000, losing a grand total. But what if it went to $50 or even $100? The losses are infinite on short selling, and many people have been completely blown up and have gone into debt with their broker from being wrong on a short position that went out of control. The rest of this video will primarily focus on going long stocks because that's what I focus on, but it's important to know that short selling exists as they are the opposing side of every trade. As ancient proverbs say, it's important to understand what your enemy does in war, and we'll go into more depth into the psychology of how longs and shorts interact in the market later in the video. So now day trading basically takes this entire concept and looks for stocks that are volatile enough to give you the opportunity to buy and sell in the same day. It wouldn't be very worthwhile for most traders who are looking to get into day trading to look at stocks that are worth over $100 per share, because the likelihood of those huge companies moving a lot is very slim. Even if you wanted to make $100 on the stock going from 100 to 101, you need to buy 100 shares of that company, which is a 10 grand investment. So day traders typically like to look for lower priced companies that have a lot more volatility, meaning they can move 10% or more in a single day. It's not uncommon to see a stock go from $1.50 per share to $2 per share in a single day. And if you put 10 grand into that same trade, it would be around a $3,000 profit. So now that we know what the objective is when we're day trading, we need to now cover how to read stock charts. And the most common chart that you'll be dealing with is what's called a candlestick chart. So candlesticks are a visual representation of the opening price, closing price, and highs and lows that is set period of time. So basically, if you're looking at a 5-minute candlestick chart, each candle will represent 5 minutes of price action and give you information about each 5-minute segment of the trading day. So there are two basic types of candlesticks, a green candlestick and a red candlestick. Both contain the same exact price action, but red candlesticks mean that through that trading period, closing price was lower than the opening price, resulting in the overall price decrease. Green candlesticks mean that the closing price is higher than the opening price, resulting in an overall price increase. On most candlesticks, you'll see these wicks, which just show the highs and lows during that period of time. Now, just to get some more context of exactly how candlesticks are formed, I created this graphic to signify that two candlesticks can look the same. However, the actual price action during the period can be very different. So the big candle on the left side of both images represent an hourly chart, and the candles to the left of those are that same price action represented in a 5-minute chart. Notice that overall both had the same open, the same highs and lows, and the same close, but the price action was very different. The first candle tested the lows, then pushed into the highs and closed high. The second candle spiked up, made those highs, pulled all the way back down to the lows, and then ran back up and closed strong. Hopefully this allows you to conceptualize exactly what's happening within candlesticks a bit better. So now that we have a basic understanding of how to read candlesticks, let's move into learning what technical analysis is through real examples on the stock chart. Technical analysis is the methodology of forecasting what price can potentially do in the future by analyzing past market price action. Now, there are many ways of conducting technical analysis. The three primary ways are through trend lines, technical indicators, and horizontal levels. Now, before we can talk about any of these three things, we first need to establish the key point of technical analysis, and that is identifying support and resistance levels. So, what is support and resistance exactly? Support refers to areas on the chart where a downtrend is expected to stop and reverse because of buyers coming in, which leads to an increase in demand. Resistance is the opposite. It's areas on the chart where an uptrend is expected to stop and reverse because sellers are coming in and selling shares that they possess, leading to an increase in supply, which causes prices to drop. If you have taken any intro economics class, then you'll understand the relationship of supply and demand, but if not, we'll explain it real quick here because it is an absolutely foundational concept to trading. It breaks down into a few key ideas that we'll explain using this simple graph. The axis on the left represents the price, and the axis on the bottom represents the quantity of things sold. Let's just say in this example that we're dealing with gasoline. So first, let's plot the demand curve. Everyone would love to buy gas at the lowest price possible, right? So the quantity willing to be bought at $1 per gallon will be the highest point, and then the trend downwards as the price increases because no one wants to buy gas at 10 bucks per gallon. Now for the supply curve, it's completely opposite. No one wants to sell their gas for $1 per gallon. They want to get the highest price possible. So the quantity able to be sold at $1 will be very small, and as the price goes up, the amount willing to be sold goes up as well. The point at where these two lines cross is considered the equilibrium price, but we'll just refer to as the market price from here on out. So based on the supply and demand of this imaginary market, the price of gas is $5 per gallon. An increase in demand line leads to an increase in market price, and a decrease in the demand line leads to a decrease in market price. But an increase in the supply line leads to a decrease in the market price, and a decrease in the supply line leads to an increase in the market price. So the whole goal of technical analysis is to try to find points and areas where there are likely increases or decreases in supply and demand, and use those in your favor. The three types of areas that most traders use are trend lines, indicators, and horizontal levels. I primarily use horizontal levels, but we'll explain all the others just so you have a more rounded view of the markets. A trend line is a line drawn on the chart that connects multiple pivot points together to show the overall direction of price. Typically, when you're able to connect multiple obvious points by a line, there's a good chance, but no guarantee, that the price action will continue to bounce and continue along that line. If the trend line fails, it could be an indicator of a trend change and reversal. The idea is that when the price is under a trend line, it can act as resistance, and when it's above, it can act as support. So let's just hop into the chart of AAPL and see if we can draw some relevant trend lines. So here is the hourly chart of AAPL. Once again, that just means that each candle that you see here represents 1 hour of price action. And let's just, practice drawing some trend lines. I'm not going to go too in depth. So I can see one trend line here. You can see the price kind of follows that line, bounces along quite a few times. There's another trend line right here that you can draw. Like right here, you can draw a trend line too. You can draw them on any time frame too. So like, for example, you can see some larger patterns here on the daily chart. Like right here, there's kind of a large trend line that's formed. Not really too exact though. And that's why I said that, trend lines are good for just seeing overall trend. But as far as giving proper entry points, in my years of experience, haven't really found too big of a use for them. Now, there's lots of patterns that are created from trend lines. I'm not going to go through them all because honestly, I don't find trend lines particularly useful at all for my trading systems. The most common forms of patterns derived from trend lines are wedges and triangles, which can signify a strong move to come depending on which side of the pattern is broken. For example, bullish wedges and ascending triangles can mean that there's a strong price increase is about to happen if the top of the patterns are broken. Similarly, a bearish wedge and descending triangle can mean that a large price drop is going to happen if the bottom is broken. The main cons that I have experienced with trend lines is that while they may be good for identifying the overall market trends, they are really not that reliable when it comes to giving actual price entries. Sometimes trend lines can last for a long time, but they often need to be readjusted. Also, there's a lot of variance in how you can draw the trend line, since many traders will connect points at just the wicks, just the candle bodies, or a mixture of both, leading to vastly different trend lines. All right, so next is technical indicators. Indicators are basically formulas applied to previous price and volume history, which are then used in the attempt to predict future prices. With this in mind, it's important to understand that most indicators tend to lag behind what price is currently doing, since the formula is still using past price. Now, there are literally thousands of different indicators such as moving averages, MACD, VWAP, Bollinger Bands, stochastics, and many more. The best example of this lag happening is shown in indicators called moving averages. A moving average simply takes the past number of candles, calculates the average, and then spits out that number. So for example, a 50 moving average just takes the past 50 candles and finds the average price. A 200 moving average, you guessed it, takes the past 200 candles and finds the average price. There are a few different types of moving averages. The most common are simple and exponential, and the main difference is that exponential moving averages take the more recent price action and weigh it heavier in the calculation. Let's look at some examples of that. Here, this light blue line is the 9 moving average. So it just takes the price average of the previous 9 candles at any specific point. And if we just, lower this down to a 1 moving average, you'll see that it follows the close of each candle perfectly because it's only taking the average of that one candle. So now if you look at the moving average, you can see that it just follows right on the close of each candle because it's just a 1 moving average. And you can bump it up to, say, a 50 moving average. So now we're looking at a 50 moving average. So basically, it takes the last 50 candles, takes the average, and plots it at that specific point. And generally, the higher number that you have in the moving average, the more kind of sloped or smooth the moving average will be. So if we bump this up all the way to, say, a 200 moving average, you'll see that it gets very kind of, sloped out. And you can see the overall trend, and it's really used just to identify trends. Okay, so now we have both the simple 200 and the exponential 200 plotted. The exponential is the red line. And basically, as you can see, it's not a huge difference, but it just weighs the more recent price action a bit heavier. So if we change these both to a 9 moving average, you'll see that the 9 EMA, which stands for exponential moving average, just stays a bit closer and reacts a bit quicker to the more recent price movements. And that's basically the main difference of the EMA and the SMA. Now, a lot of people like to use moving averages for what are called moving average crosses. So this is basically when they have two different moving averages and they will react to it when they see it cross. So here's a good example. You can see that the 9 moving average is crossing above the 50 moving average. And people will kind of take this as a hint that the more recent trend is starting to shift upwards, and some people will buy based on that. And while it does kind of work sometimes, the main drawback that I see to this strategy is that it's really lagging behind the actual support test. Like for example, here, Apple bounced off of 137.50, but the cross didn't really happen until Apple was at like 138. So you're already losing about 50 cents per share. And that's, my biggest con that I see to using moving average crosses. Now, with that in mind, there are two moving averages that I do use, but not in the way that most people use moving averages. Those are the daily 200 simple moving average and the weekly 200 simple moving average. I use these primarily as levels of support and resistance, and it's important because support and resistance is literally what my entire trading style is based around. Another indicator that I also use as a level of support and resistance is VWAP, which stands for volume weighted average price. I have an entire video breaking down VWAP, which I'll link at the end of this video if you want a complete guide on it. I use the intraday version, meaning it takes the price of every share traded that day and calculates the average price and plots it. Because it resets every morning, you'll tend to notice that it moves pretty quickly at the start of the market open, since there isn't a lot of total volume, meaning that volume influxes will impact the overall average higher. As the day progresses, VWAP starts to flatten out because a day's volume is much larger, and volume also typically tends to die out as the day progresses as well, meaning you need to see a huge influx of volume and price for VWAP to budge at all. Now, I mainly use VWAP for two reasons. One, to understand if a stock is overall bullish or bearish, and two, as another type of support and resistance. Generally, if a stock is above the VWAP, it's considered bullish, and below, it's considered bearish. I think it's an extremely powerful level of support and resistance because it's literally telling you where the average price of all the shares traded that day are, meaning that traders are very likely to react at it being at that price. And we'll break down this concept a lot further in our trader psychology section. But basically, if you're down bad on your position and the stock comes back up to your break-even point, you're more likely to react to that by selling and taking the tiny loss, right? This would cause a higher supply to come into the market and cause prices to drop further. Like I said, very quick intro to this idea, but it's a massive one that we'll break down a lot further in the psychology section. All right, so last thing about indicators before we move on. I don't know why, but for some reason, beginner traders love to obsess over finding the best indicators. I know this because I did the same exact thing when I first started trading. I thought that finding some special pairing of indicators meant that I would be able to predict the market 100% of the time and always have great entries, and boy was I totally wrong. The best advice that I can give you is to use as few indicators as possible and really focus on learning how to read price action, because at the end of the day, all indicators are calculated from volume and price anyways. So I think it just makes sense to learn to read price action directly. All right, so now on to what to me is the most important part of technical analysis, which is horizontal support and resistance levels. Horizontal support and resistance refers to a price level on the chart where you can see extra supply and demand coming in, reversing the trend. For support, it's a price level where downtrends can be expected to pause due to a large amount of buying interest at that specific price. Here's an example of a very obvious support level on Google. Notice how it constantly bounced off that 2020 level for nearly a whole month before moving higher. That is an obvious level of support, and when support is identified, it can be a very smart entry point. You won't know if the support holds until it actually continues, but you know that if the support holds, you have the best entry point possible on that specific setup. Here's an example of resistance on AMD. Notice how it spiked up to the $58 area many times, but kept on stopping and reversing at that level. That's because sellers identified it as resistance and decided to sell every time it got to that price, driving the price back down. When the stock breaks over resistance and makes a big move higher, this is called a breakout. AMD did a very nice breakout above that same 58 level. Similarly, when support breaks down and the stock moves lower, that is referred to as a breakdown. Here's an example of that happening on JAN. The daily chart bounced off of 580 multiple times before breaking down and selling off massively. Another huge rule of horizontal support and resistance is the idea that previous resistance becomes new support, and previous support becomes new resistance. And this is the core of my trading strategy. Many people would look at the previous charts and think that the thing to do is simply buy the breakout or sell the breakdown. But I take it one step further and let the stock break out, wait for it to pull back, and then take the risk into buying the previous resistance as new support. This provides me a lot better structure behind the trade, and I'm able to manage risk a lot better by doing this rather than just blindly buying breakouts, which can commonly reject, especially on day trades. We're going to go into actual examples of trades that I recently took that are all based around this idea. And I won't only show you winning trades, I'll show you losing trades as well so that you can see exactly what I do and how I manage my risk. So here's a trade example of my key trading strategy that I like to call buying the pre-market high as new support. I'm just going to break it down step by step on the stock HTCR. I traded this on June 8th, 2022. I like to find stocks that have news in the beginning of the day, and I plot out the pre-market high. That's just the highest point made in pre-market. You can see that's around 133. So that's my entry point. And then as far as my max loss, I just use the next level of support lower. So here you can see that's around 115. So right here, the trade is kind of already planned. I wait for the stock to break out above pre-market high, and then I send limit orders at that pre-market high as new support. I'm going long at 134, and my max loss is the break of 115. Now, with all of these trades, I never know if it is gonna hold, but I know that if it does hold, I have the best entry price possible. But basically, that's my strategy. And then as far as profit targets, I just go to the higher time frames, so like the daily and weekly chart. And once again, I just mark off previous points that the stock either found support or found resistance. So here we can see there's some points here near 177, 168. There's a point here at 231, and then up here at 350. And basically at each of these points, as high as it wants to go, I lock in partial profits along the way because I don't know which one of these can hold as resistance, but I know that it always has a potential to hold resistance at these points. As HTCR spiked up, I locked in some profits into 168. And because the trend was able to keep on holding upwards, I kept on holding the stock. As it spiked higher, I locked in more profits into the 230s, and it kept on continuing upwards. I had more limit sells waiting at 350, but those never filled because the stock ended up finding its top near 320. And I didn't really exit this until we saw the afternoon breakdown, and then I sold back into the VWAP as resistance. So I'll flash the executions here so you can see that's basically how I followed it, right? I went long 134, took profits 168, took more profits 230s, sold the rest into the 240s. Okay, so here's another trade example that I did on AERC. Now this is not buying the pre-market high as new support, but overall, it's still based on the idea of previous resistance holding as new support. This is actually called a day 2 strategy. And basically we can see that day 1, this thing was able to spike up pretty significantly. And we did have a point of previous resistance here on the hourly line chart. So I marked that off right near 390, and the stock was able to break out higher and set a new resistance at 533. And the next day I had this on my watch list, and I made a plan to buy the dip into 390 as new support. My max loss in this case is using the next support lower. Here it's very tight, right near 381. So that was my max loss if the stock failed. But as we can see, the candles overall held 390 perfectly. And then once again, I always like to lock profits into known levels of resistance. So as the stock spiked up, locked in profits at 533. And then once again, using historical levels from the daily and weekly. So I had a level marked off at 801, at 846, and then at 1284, I locked in some more profits. And I'll once again flash that trade execution chart on this page. Now, this was one that I held overnight, but then I ended up exiting it because on day 3, it failed to keep holding my level at 910, so I sold the rest. Now, here's another example of a very similar setup using the hourly chart. Once again, here on Redbox, RDBX, we can see that on May 26th, it set this resistance at 920. Next few days, it pulled back and then it was able to break out and ran to 11 bucks. After it broke out and ran to 11 bucks, I knew that we had this previous resistance at 918 that could hold as new support. Once again, I had no idea if it would hold, but I knew that if it does hold, it's the best entry possible. So I took the risk, and on this one, I actually bought call options since they were available. Next few days, it kept on testing support. It never actually broke down. You can see all these held, and then on Friday, it was able to break out. Once again, locked in partial profits into the known resistance. And then my next target was from the weekly chart. You can see here, there's a very obvious point of resistance at 1568, and I'm still waiting to lock in profits there. Okay, so those were all examples of winning trades. I know those are great, but most of my trades don't win. I actually have a win rate of less than 50%. So I'm gonna show you some examples of trades that I took the trade and it failed, and why I'm able to manage my risk and why I have that max loss level. So here in this case, I wanted to trade BIMI, just a small penny stock. I wanted to buy it off of the previous day high as new support. And in this case, my max risk was the break below 52 cents. Now we can see here, so the stock fell down at market open and I got filled at 63 cents. But then you can see that the 5-minute chart did not hold that level perfectly. And when I see that, my goal here is now to sell for break even as long as it holds above my max risk. So you can see here, it never hit my max risk level. So I never got hard stopped out. But during this time, as it was consolidating underneath, I had a limit sell waiting back at 63 cents because I wanted to exit the stock for break even. And then the stock popped back up and I got filled and I lost pretty much nothing on this trade. And now lastly, here's an example of a stock that did hit my max loss. So here in this trade, I was looking at the previous day high as new support to hold at 102. And I bought the dip at 102. My max loss was once again the break below the previous support down here at 93 cents. And the stock closed underneath my 102 entry. So at that point, I sent orders to try to sell for break even, but the stock kept on falling down. And once it crossed through my max loss, that's when I just hard stopped and I took the max loss. So those are examples of my main trading strategies, all based around horizontal support and resistance, and the idea of previous resistance becoming new support. Now let's talk about risk management. So most people approach risk management the wrong way, and they tend to ask, how do you manage risk during a trade? And my response is almost always, you don't. Risk management is performed before the trade through planning the trade and sizing appropriately. Remember in the previous section when I was giving my trade plans, and I always had 3 key levels in mind: my thesis or entry price, my max risk level, and my profit targets. These are essential to identify before your trade, and it's solely the purpose of managing risk. So when it comes to risk management, the main rule that I'm going to teach you is the 2% rule. And this rule basically means that you never want to risk more than 2% of your account on any single trade you take. So this means if you have $1,000, no losing trade should be larger than a $20 loss. The reasoning for this is it means that it would technically take around 480 max loss trades in a row for your account to go to zero. And unless you're the absolute worst stock picker ever, that is almost never gonna happen. But because we know that trading is inherently a game of uncertainty, and we never really know which trades are gonna win or lose, it's important to be able to live through losing streaks in our system. They will happen. Just assume that your win rate is 50%. You will have times where you have 4 or 5 losses in a row, sometimes even more. And if you don't have your max loss per trade under control, you will quickly be wiped out during those downturns. So how do we make sure that we don't risk more than 2% on any single trade? Well, I made this simple calculator where I can just input my account size entry price, and max loss. And it tells me exactly how many shares I can use for that trade. Boom, easy, no guesswork whatsoever. Some trades will have a tighter max loss based on the chart, so those ones I'm able to take more size on. Some trades have larger range in the max loss, so those ones I take less size on. But the risk is managed before the trade, not during it. So we talked a lot about technicals and actually trading, but I 100% mean this when I say it. Trading is like 5% knowing about how to trade, 95% about actually doing what you know is right, and the psychology of trading is what makes this so difficult. How many times have you known that you should enter a stock or take profits, but you ended up not doing so because of the fear of losing, fear of missing out on more profits, or became too greedy? Well, you're not alone, and these emotional triggers are literally what drives the market and is one of the reasons why price support and resistance makes so much sense to use to me. Regardless of whether someone is being long or short, they will buy a stock because they think it's going to go higher. And they will sell because they think a stock is going to go lower. Makes sense, right? If you're long, you want to buy low and sell high. And shorts just sell high and buy low. But the same overall idea behind price movement drives both sides of the trade. And there are 4 main trading fears that all traders deal with: the fear of missing out, the fear of losing money, the fear of being wrong, and the fear of leaving money on the table. And realistically, most of these fears simply stem from not having confidence in following your system or trading strategy. The simple fact is that you can't have the fear of losing money because every single trade has an uncertain outcome. And if you plan the trade ahead of time, then you know exactly how much money is on the line, and you should be okay with that risk if you're choosing to enter the trade. Can't be afraid of being wrong because, like I said, there's no guarantee with any single trade. And if you're afraid of selling too soon, well, as long as you are selling because your system tells you to sell, then it was actually perfect execution in the end. And a huge part of trader psychology is the idea behind bag holders and shorts being trapped. A bag holder is someone who is down bad on a losing position. For example, if someone bought Netflix at $700 and is still holding, they're bag holding badly. And why do all bag holders continue to hold? Simply, they want to try to get back to break even. So this means that this person who bought Netflix at $700 will likely exit when that losing position gets back to $700 because they don't want to suffer through the mental pain that they endured while Netflix was terribly down. This is the core psychological reason why we see previous resistance hold as new support and previous support hold as new resistance. Let's go back to the example from another trade that I took on RDBX. From this chart, we can see that there was previous resistance around 920. So that means that at 920, there was net more sellers than there were buyers. And let's just consider short sellers in this case, since it makes it simpler to understand. So imagine being short at 920 and you're holding for this whole time, but then all of a sudden RDBX breaks higher and runs to 11. You're down a lot unrealized on the position, but didn't want to take the big loss. So you hold and hope for it to get back down to break even at 920. When it starts to approach 920, you're going to be very compelled to buy back your short, right? That induces buying pressure and thus influences the stock to hold support. Boom. Previous resistance, new support. And it's the same exact idea for previous support holding as resistance. Longs who bought the support held through the big breakdown and then used the bounce back to sell for break even, holding the resistance and influencing for the downside. All right, so I can safely assume that you learned more from this single video than from all of the countless things that you've probably watched on the topic of day trading. And I truly hope that this helps give you clarity and a path on exactly how day trading works. Obviously, there is so much information that I have gathered in my 6 years of experience. So unfortunately, I wasn't able to fit all of it into this video, but I do have another free 1-hour trading masterclass where we dive into the specifics of actually finding, developing, and practicing a trading strategy and getting what I call data-backed confidence to execute without those trading fears influencing you to make bad decisions. It's completely free, and all you have to do is click the link in the description to reserve your seat. Also, I trade every day with my community called Trade Buddy. I create watch lists, do live trading webinars, and post all of my trades in the chat room, plus a lot more perks like the trade review and a trading course. There's free 14-day trial for this, so you can literally come in, take all the content, and if you don't like it, just cancel. No questions asked. You can visit tradebuddy.net or click the link in the description to learn more about this. Lastly, if this video was helpful at all I ask is for you to hit the like button to let YouTube know that they should recommend it to other day traders who are struggling. With that being said, thank you so much for watching my video, and I'll see you in the next one.